संजीव जी नमस्कार।
नमस्ते, हाउ आर यू?
सब बढ़िया सर।
गुड।
ऑल वेल। कौन कौन आ गए? ओ काफी लोग हैं। किस लोग हैं?
अरे, जो वेबिनार ही इंटरनेशनल है तो काफी लोग आएंगे आज। भावे जी
यस।
शायद कुछ डॉक्टर के गए, उनको प्रॉब्लम है, अदरवाइज
हाँ
ऑल
हाँ।
डिग्निटरीज हैव ज्वाइंड।
और नितिन जी भी आ गए आज। वेरी
हाँ,
गुड,
आज
बहुत टाइम के
तो
बाद।
महान लोग भी आ गए, नितिन जी भी आ गए।
नितिन जी कहाँ हैं?
महान लोग तो पहले से मौजूद है भाई।
हाँ। जरा
सेकंड।
फोटो लगा रखी है आपने।
हाँ,
बस
फेस दिखाओ, आपकी शक्ल देखे हुए बहुत दिन हो गए अब तो।
हाँ बहुत टाइम हो गया भाई।
गुड
अच्छा,
इवनिंग संदीप जी।
गुड इवनिंग। क्या हाल है भरत जी, बड़े दिनों के बाद आप?
हाँ थोड़ा बहुत चलते रहता है।
चैट बॉक्स में अपना नंबर डालना है ना?
हाँ नहीं
हाँ,
अभी डाल रहा हूँ।
अभी डाल देना थोड़ी देर में, नेम एंड वो
हाँ जी। हाँ
हाँ हाँ डाल देता हूँ।
थोड़ी देर में डालते हैं,
हाँ,
फिर चालू होगा।
अभी
थोड़ी
आज
देर में क्यों?
हमारा इंटरनेशनल वेबिनार है। आवर स्पीकर इज डेलिबरेटिंग राइट फ्रॉम न्यूयॉर्क।
ओ
अच्छा। ओ
उधर टाइम क्या हो रहा है अभी? सुबह
संदीप जी,
8 बजे।
8 AM।
8 o'clock इन द मॉर्निंग।
यस यस।
ग्रेट।
हेलो कृपेश।
हेलो।
इसलिए आज हमने इंट्रोडक्शन के लिए भी इंटरनेशनल उसको रखा हुआ है, कृपेश को।
अच्छा अच्छा गुड गुड।
संदीप जी ना ऐसे ऐसे बोलते हैं ना कि बस आदमी सामने वाला हिल जाता है। क्या भूल गए?
नितिन जी, आप दो चार शब्द कहो इनकी। उसमें आज भावे जी तो कुछ डॉक्टर के पास गए, शायद उनको कुछ प्रॉब्लम है।
ओ, अच्छा तो भावेश जी
कौन से दो
नहीं,
चार
हम्म।
भावेश जी
कहेंगे?
अपना
कृपेश जी कहेंगे यार,
प्रपोज
आप ही
जी
कह
तो
लो।
फॉर्मल वो कहेंगे ना, इनॉग्रल, उसमें आप वैसे बोलो। अब भावे जी
नहीं,
को
आप ही बोल दो, मैं तैयार नहीं हूँ।
यार, जैसे मोदी जी तो एक्सटेम्पोर ही बोलते हैं ना, आप वैसे बोलो एक्सटेम्पोर।
मैं मोदी नहीं हूँ ना, खाली मेरा डेट ऑफ बर्थ कॉमन है उनसे।
तो
अरे वाह।
आधे गुण तो आते ही है।
हाँ
सर आपका जोडियक और डेट ऑफ बर्थ दोनों उनसे मैच है,
हाँ, बिल्कुल।
चाहे नितिन हो चाहे नरेंद्र हो।
हाँ हाँ।
नहीं, मेरा नाम वो कुंडली के हिसाब से एन से नहीं स्टार्ट होता है।
अच्छा, ओके। सो कैन वी रिक्वेस्ट संदीप जी, कौन who is going to do a welcome speech and
वही करेंगे संदीप।
वेलकम ही है तो। वी ऑल नो वी हैव टुडे ग्रेट स्पीकर who is deliberating right from New York, and he is, as all we know, he is IM MBA from IM, and he is also gold medalist, and he is running a startup company. So now, Krupeji, you just do the formal start presentation and introduction so that we don't waste much time and we can get more and more from him.
sure sir, thank you. Okay, so just give me a minute. So, sir, before, so it is always a I see a Krupesh Mansari. It is always pleasure to introduce speaker when the person who is a very dynamic. But before that, I would like to state about of Association of Valuation of Professions. So basically what we are. Okay. So AVP is, so let's talk about of AVP. Just a second, why it is not. Okay, so it has been, AVP has been formed or founded by our President Ram Mohan Bhave sir. Okay, his main objective of forming is for interest of valuation professionals. So we found that there are people who are not, although they have become valuers, and to how to protect those interests and how to educate. Looking at that, we have formed this Association of Valuation of Professionals. Okay, Association of Valuation of Professional has a tie-up with IIVRF, that is Indian Registered Valuer Foundation and SME Chambers. I will talk about further about IIVRF and SMEs. So let's talk about AVP life memberships. How you can become a AVP life member? Is it necessary that you should be a registered valuer? No, we are not here to be. You should be a registered valuer. That should not be a criteria. The criteria is very simple. That you can become a life member just by paying a nominal fee of 5,000 rupees one time. Then there is no recurring fees. Any professional interested in valuation can become a member. So just I said that it is not necessary that you should be registered as a valuer. Any person who is interested in evaluation, he can become a member, whether it's in India, outside India, or anywhere. What are the milestones we have achieved as a AVP? We have within last 8 months. We have tie-up for CEPRs with IIVRF, that is a registered valuer organization at Pune. We are having 152 members from foreign countries as in India as well as from foreign countries. So we are having, I can say, all continents. We have covered as far as our members are covered, whether it's Australia or whether it's USA. We are having iconic personalities like past president from ICMI, internationally certified valuers, and prominent speakers. We have already issued 8 newsletter, 1 Independence Day special newsletter published so far. So this is basically newsletters on a different topics to give more ideas and insight about the valuation forum. We have already covered 38 webinars covering different topics held by the legends. So now what we have done a tie-up with the IIVRF. So what is IIVRF? IIVRF is an India Registered Valuer Foundation, is recognized by IBDI as a registered valuer organization as per provision of Companies Act Rule 2017. Ilyas Anil Sheikh is the managing director of IIVRF. IIVRF is the main motto is to develop a profession of valuers. IIVRF has been contributed immensely to enhancement of value through academic program and imparting technique. So we have done the tie-up with the IIVRF. We are lucky, and so because of that, our members also getting a CEP. IIVRF has conducted 50 hours training program for registration of RV with IBBI for all class of assets. Whether is basically IBBI having a 3 type of asset classes: SFA, land building, and plant and machinery. Luckily, IIVRF has all the 3 class of assets you can register. Till date, IIVRF has trained 1,400 members for IBBI, 50 hours training, and 246 members are successfully registered with the IBBI. That is one of the major achievement. Then further, we have tied with the SME Chambers of India. So basically is promoting the small and medium enterprises in India. So working for a development of SMEs from manufacturing, service sectors, and allied industrial businesses sector for the last 28 years. So we can see it's roughly around 3 decades. Providing unique support to SMEs, young women, enterprise, startups, and convert business ideas. So when today's topic is SaaS valuation, when you are making losses, here SMEs are helping them how to develop a business. Converting new concept into profitable business, venture better development, as well as transitions and transformation.
Brush, keep your clothes in the closet, okay?
Yeah. So, sorry, can I continue?
Yes.
Further, this is generalizing finance from bank, FIs, foreign.
Shweta Srivastav, can you mute yourself, please?
What hurt you? Daddy has to put them up.
Shweta Srivastav, can you mute yourself?
Okay. So generalizing finance from banks, financial institutions, export finance, venture capital for enhancement of business activities. This is the main motto of SME Chambers. Now, why to join AVP as a life member? Just we have said. Now, what are the advantages when if I join a AVP? basically you are getting a free webinars, at least 2 each month. So we have already conducted 38 webinars. Very honest with you, when I have cleared my this registered valuer, and when I'm joining this, and every time I'm getting a different insights and insights. Okay, so that is a major benefit why I have joined AVP. Mentoring newly registered valuer and mentoring students, both. It is not only for students, but registered valuers. Monthly e-newsletter for sharing knowledge. Networking, national and international level. So your doors open not only in India, but outside India also. Study of IVS and valuation standard issued by various bodies. Can participate in activities various committee form. Yes, it has helped me a lot. Chance to attend international webinar at a discounted price. This is the most crucial. By paying you 5,000 rupees and you are getting a discount at the webinars. Formation of various study groups to enrich our knowledge in particular area of work. 25 days knowledge sharing event already fixed for the upcoming year. So we for in next 1 year, the webinars are already, topics are already fixed. And CEP is credited under the CEP in association with IIV, RVF, RVO. So that is another, so you don't have to go here and there for your CP. Okay, once you become members, and we are already tried with the IIV, IRF. So that is the advantage. So that is the reason I request everybody participate who are not member to join AVP as a life member just by paying of 5,000 rupees. It is a really great help to all of us. So these are the topics, various topics. That is why I'm saying next 25 topics has been already been by 25th September 22. We are already booked. So that is a major advantage. By the way, next topic that is on 10th of December is going to be conducted by me on Excel tools and formulas for evaluation. So how you calculate different value tools, that we will discuss in that at length. Now I would like to, so now whom you contact for any queries, our President Ram Mohan Bhave. For membership, Head of Resource Committee Nitin Brahma, his phone number is already available. And if you are in any webinar related query, Sandeep ji is there. He is really a backbone for our AVP. Now I would like to introduce, and it is a pleasure to introduce our today's speaker, Shivam Nayak sir. Shivam Nayak sir is a valuing, so he is going to taking a very unique topic, valuing the Saas company, so software as services. On that he is going to speak with us, and he is going to enlighten on that. Finding a diamond under the pile of mounting losses. So all we are having a issue that okay, companies are making a lots of losses. Okay, and how to value those type of losses, loss-making companies. With that, he is going to enlighten on us. And yes, obviously, one of the favorite topic is software as services. So, Mr. Shivam Nayak, it is a very pleasure and welcoming to you. You are right now in the early morning at New York. So he is he's going to speak from New York right now. So let me introduce him. His current role is he is a founder of Rezone Find. Okay, and that Rezone Find has been started in July 2016. He is a co-founder of fintech startup Rezone Finance, where he's a chief product manager. Developed fintech using full tech technology, including Python and R. Sir, you are a guru of Python and R, and I love to hear from you, because of Python is like Latin and Greek for all of us. But yes, if we want to survive in this world, we have to learn. He has helped some of the largest multinational banks in the country offer better trade solution to their customer. His previous work experience, he was ex-Citi banker. He has managed a trade book of more than 1.5 billion and cash and security products of revenue more than $10 million. Okay, academic and professional qualification. He is IIM MBA and with the gold medal, and he has trained more than 500 learners across Citi, IIM, and Poland platform in banking and finance, Python and coding domains. And it is my very pleasure to introduce Sir
Hi, Krupeshji. Thank you for the warm introduction. I'll just share my screen and I'll take over from here. Yes, I think everyone can see my screens.
Yes, your screen is, yes, we can see your screen.
Awesome. So the topic that I've selected for today is called valuation of SaaS companies. It's a topic which is quite hot right now with a lot of IPOs of SaaS companies coming in like Paytm, Nykaa, Zomato, etc. So I just thought I would shed some light to it. Obviously, a lot of you are experts in valuations and a lot more knowledgeable than me. But I would like to present a different perspective. So I've kept this talk very non-technical, kept it at the bare bones basics. And I've tried to sort of build a story and a narrative that helps you understand what goes behind valuations so that you can differentiate between good SaaS companies and bad SaaS companies. So that's the objective. Just a short background. I think the picture that Krupeshji had put in was of the wrong person, but this is me. Everything else that he said was exactly the same. And just to say that both these topics of finance and coding is very close to me. I've worked across both these domains and I do teach them very passionately. Moving on. Something which is just to get it out of the way, that nothing that I mention in this talk should be construed as financial advice or an advice on investment in any of the companies. And some of the examples have been specifically modified to sort of highlight a concept that is being imparted or taught. So just bear with that and understand that some of these values would have been sort of altered and modified. So don't hold me for that. Just to set an agenda and pictorially just sort of setting it on what different topics that I would be covering during this entire session. I'll try sticking well within the time. The first and the most basic topic is DCF. That is the only form of valuation that I use and that is relevant for today's session. Obviously, there are multiple different methods and that can be used, but the only reason I'm just touching upon this is because I would just like to ensure that everyone is on the same page. The second theoretical concept that I would be covering is characteristics of a SaaS company. The reason I would highlight this is because while we've taken the example of a SaaS company and we would look at this entire talk with the lens of a particular SaaS company, it is not limited to just SaaS companies. A lot of companies exhibit traits that are similar to a SaaS company, right? So if you look at Reliance Jio, that's a telecom company, but it exhibits same traits as a SaaS company. And I will explain why. And so just to understand what are the traits that we are looking for in a SaaS company, is it always losses and what those and why are there losses and what they are, and we will look at that. And then from an informational perspective, I would cover 3 different stages of investing in a SaaS company. The first is an early stage investing in that SaaS company. The next is VC investing, which is typically when you're looking for growth in SaaS companies. And I would also look at this entire perspective from the concept of value investing. So if you are somebody who follows Warren Buffett, Graham Barrett, etc., then value investing, how does it hold up to the principles of value investing? And I would try to sort of demystify some of those points. Again, I've kept it very light on the theoretical aspect. It's more informational and more easier to understand. So if some of the numbers that I put out seem arbitrary, just go with it, and you would see that you could easily back calculate those numbers from the relevant information on that slide. Okay, so getting right into the first topic. Again, a very short and simple way to look at DCF, right? again, the way I do it is I always try to put everything pictorially for me. I try and understand things in diagrams, and only things that I cannot explain in diagrams, I try and put it in words. So very simply, in a DCF, what you do is you look at the left side from actuals. You try and calculate what the estimate is, what the revenue is actual, what the cost is. Then you add back certain non-cash expenses, and then you subtract all actual cash expenses to get something what is called a free cash flow, right? So what you need to do is you need to project for 10 years ahead at the 10-year stage, right, which is way far ahead, right? Because beyond a certain point, once you start calculating present values of cash flows, which are 15, 20 years into the future, they will have small impact, but they would have meaningful impact. So you would need to calculate something which is a terminal cash flow. Beyond that, once you do that, you calculate the free cash flow for a company. You decide what the discount rate is, right? And once you decide the discount rate, you calculate the NPV, divide the NPV of the company with the current stocks that are outstanding in the company, and you would get price per share. This is all that you do in DCF, and this is what you should compare, right? So once you get a price of a stock, you would want to compare this. And I will explain during this talk different situations on how we do this and how we come into this. But in theory, this is all that we do, right? We're trying to calculate what the free cash flow for that projected company could be. It could be, you could even do something which is called a split decision tree, cash flow modeling, etc. All of them are complexities that will be added later on. But understanding at the core of it is to only calculate free cash flow of the company, calculate the current value of all of those cash flows and the price. Once we do this, what do we do, right? So just calculating this is not enough, right? You need to take an action on that, right? So there are only two actions that can be taken basis that. So if you calculate your actual price to be significantly higher than the price that is observed, right? So if your calculated price is 100 rupees and you observe that the price of a stock is 75 rupees, that's when you take a buy decision. You buy that stock. And if you find the inverse to be true, if your calculated value is 100, but the actual price is 125, you sell. It's a very simple binary decision. So once you've put things into number, so as valuers, we try to put everything into numbers. And once you put into numbers, these are simple decisions that we need to take. However, what is not clear is that how you arrive at these numbers, right? So calculating P in itself is a very big challenge, right? How do you calculate the price of a stock? And this is what I will try and cover. So this is the entire theory that we would need to look in for today's session. Everything ahead is more conceptual, and it is just about how we are going to arrive at a P calculated. So moving on, if you look at different stages of a company, there are companies which is an idea stage. Then there is a company that would need, say, an angel investment once it grows certain bigger. Then you would have multiple series, is A, B, C, D, whatever number that you do, which would be private investors. And then at one stage, you would get really large PEs investing in it, or it would just be pre-IPO or just reaching a stage where it would be ready to do an IPO or be bought over. That's the beyond stage. So we would look at all of these 3 or 4 stages, and then you would try and value a company and understand what are the nuances that we need to look at it. Right? The easiest is the first stage of investment, right? Say today I wake up and I realize that, I am very heavily invested in TikTok. I use it daily for like at least an hour, but I don't find content in Hindi. Further, I realize that there is at least 20 other languages in India for which people would want to use content in that, but they are not able to find enough content in Hindi on TikTok. So what I decide is that I will start the next TikTok for India. So that's my brilliant $1 billion idea. And I would say I would start the next TikTok for India. Right? Obviously, a lot of people can think this. There are different versions of that have already come up in India. But who at this idea stage would invest? So this is what I call the 3 Fs. It's only the founders who would invest in this idea because you believe that you can make something good. Friends and family, because you can convince them, and only fools, because if they don't know you and they're not your friends, founders, and they do not believe in you, I don't know why they would want to invest in a company at this stage, right? At this stage, there is no valuation in the company. So at this stage, all that you're putting is to put in to cover cost to reach the next stage where you can at least take an angel investing, right? So this is what we would have in the investments for the first round or the first form of capital that any company would raise, right? The next stage that comes in is an angel investment round. Now, in an angel investment round, I would like to highlight one very key criteria that you should consider when you're looking at angel investment. The order of the way the problems are being solved is important. Is there a problem? Does the solution solve that problem? It should not be the other way around. It should not be a solution that, say, if I decide tomorrow that I want to create, say, a Microsoft for India, it does not have a problem. I'm not going to say that I will create the next Microsoft for India and then look what problems I can address, right? So always begin with the problem. Always look at whether the company is beginning with a problem, right? I decided that I found that I couldn't find enough content in India on Hindi. So I said, I will create the next TikTok in Hindi or the next TikTok for India. But just finding problems and solutions that address them is not important. As an investor or as a valuer, you have to also find insights whether the problem and solution is a good fit and it's worth putting in your time and money, right? So what is more important before you decide to put in any money is to drive insights out of this. And as investors, I would say that there are only 5 insights that anyone can draw that would make it worthy for them to invest in the company. And I'll try and put some numbers to it. The numbers are, I would say, pretty self-explanatory, and that would sort of help you give a sense on what it is, right? And each of these 5 insights that I draw can either be present in a company or cannot be, right? It does not mean that all 5 have to be present in a company. It's just that if more than one are present, it gives you a strong reason to invest. If all 5 are present, you should for sure put in your money, right? So this is basically, it's just saying that you should look at these 5 different insights and say what, and sincerely decide what of these insights are present or not. The first insight we can draw is that, does the company have a founder advantage? What do I mean by founder advantage? Is that, does the founder really add value or in sort of like a lot of the company derives value from who the founder is, right? And let me put a number to this. Let me put a number of 1 to 10, right? So what I mean to say is that, is the founder just 1 in 10 people in the world who can do this? So one prime example of this is BioNTech, right? It's an MIT startup for a lot of years, etc. They have all the patents for mRNA vaccine, and they are just 1 in 3 people who could have created mRNA vaccine. So that is a founder advantage. That's a very strong advantage to have. So somebody may say that, hey, I'm a product manager in Google, and I'm a very good product manager in Google, the best company. And is that a founder advantage? No, because there are at least 100 or thousands different product managers across the world who could be equally good at executing the idea. You need to have 1 in 10 people who can do that. The next insight that you can draw is the market advantage. That means, are you growing, or is the company operating in a market that is growing 20%? Right? The number that we should look at it is 20%, right? So the point that I would like to highlight is that, say, imagine if the company does everything badly, executes very badly, but since the market is growing 20%, it will pull along the company at least, right? So we should look for companies that are operating in markets which are growing at least 20%. But mind you, this is the weakest form of power that a company would have. The next is product solution advantage. Can the founder demonstrate that their product is 10x better than the competitor? this is again a good form of advantage, and there are different ways. Like if you look at Uber, it solves a lot of problem, and there are ways that you could say that compared to taxis, cabs, etc., it had at least multifold advantage. The price was cheaper, there were cleaner cabs, there was air conditioned cabs, they were on time, and it increased the demand in the market, right? So again, you need to look whether the product is at least 10x better than what the alternative is. The next is cost of acquisition. Now, later part in this program, I will talk a lot about cost of acquisition, but at least in this angel investment stage, you need to look at cost of capital to be zero. That means, does word of mouth help this company grow? There are a lot of companies that have grown by word of mouth initially, done well, etc. That is one. The fifth power that we look for is monopoly power. Now, by monopoly, I mean not the illegal kind and cartelization. What I mean by monopoly is, do networks help increase value? So if you look at Facebook, the larger the network, more value does Facebook derive out of it. So are you operating in a business where network, so say if you are an FMCG company, the more network you have will not help you decide whether the person will buy your next product again or not. But in a social network in Facebook, if all my friends are in Facebook, it makes sense for me to still continue being on Facebook. So does the nature of your business derive monopoly power? I would recommend at least 2 of such powers should exist within a company for you to make an investment. Now, again, the next question will come is, how much do you invest and at what value? Right? The point that I would like to highlight here is that no valuation is right or wrong. All you need to do is to negotiate with the founder so that he can find the right product market fit. Right? So whatever that you are doing, that you're investing, you could say that, hey, I will take 10% for $1 million. I want 30% for $2 million. That's your risk assessment. There is no right, wrong answer. And no founder would ideally also want to pick change on this or sort of negotiate hard on this. A lot of people do that, but I would say they are missing the elephant in the room by negotiating hard on that. The idea is to raise enough capital so that you can find the right product market fit. Now, what is unique about this product market fit finding stage of a company? You need to be in cash conserve mode. You need to sort of experiment with different product ideas, different variations of the same product, because only one of them will become your viral product, etc. Right? One of them will rightly fit the market. But at that stage, you still need to conserve cash, because you could be in a situation where you may need to try a new product. You just can't keep raising money again and again for trying new ideas. You would be left with no capital, or sorry, no equity left in your company. So you want to ensure that you are in a cash conserve stage. But once a company reaches a product market fit, that's when you need to bolt. You need to sort of launch like rockets, ensure cash burn, whatever it takes to capture growth. And the switch is so stark in some of the best companies that you will see, that I will explain later on, that the switch is so stark between the cash conserve stage and the cash burn stage that a lot of people don't realize this. Even a lot of founders don't realize this, that they're actually missing the boat if they're not capturing enough market share. And that is why it is important to understand both nuances of a company. Will the company ever make money? Yes. If the company reaches a product market fit and it serves the customers well and it's profitable to serve a customer, it's okay to burn cash to make losses, because it will eventually turn the corner. So this is the second stage of investing, in angel investing, which is where you would at max look to conserve cash, but you would have one clear objective, that you need to find a good product market fit. The third stage of investing, which is typically the SaaS companies or the growth stage that I just briefly touched upon. And I will spend a lot more of the talk talking about this. The first two were just to set context and say that there is technically no valuation that happens. Right? in a SaaS company, what's happened till now? Right? You've invested very high in product. You've developed a product. Say you're a Microsoft. You've developed the Microsoft Office. You spend a lot of money to build the product, build the technology. Your Reliance Jio, you've spent billions to sort of set up the infrastructure for the telecom towers. But what happens amazingly with this company is that the revenue that you make from a single customer keeps increasing, and you keep and the revenue keeps increasing with time without you incurring significant costs. So it is something which is the graph, if I have to say, the graph would look highly negative in the first few years, and then it would slowly keep increasing in the future. This is broadly the long-term view in a SaaS company, right? But that still doesn't make us every SaaS company a good SaaS company or a bad SaaS company, right? We also need to go deeper into it. So say if the company has invested into all the technology, it's found the right product market fit, we still need to see how the customers are behaving. So typically, if you look in a SaaS company, you look at the left graph, right? That's the very common behavior of a SaaS company. You would spend anywhere a lot of money to acquire a customer, and then over the next 12 to 24 months, you would start collecting $100 or $50 or whatever in small increments over the lifetime of the customer. So you've already incurred a very high cost to build the product, and then you have incurred a high cost to acquire the customer, right? So you have already incurred the two biggest losses upfront in a SaaS business. So unlike if I compare this with traditional businesses, you get to, even though you incur a capex on say a factory or a machinery, you get to amortize it. In SaaS companies, all of these are expense line items. By expense line item, I mean that you have to incur it in the year that you've incurred it. So upfront, the company has already lost such revenues, and it's going to only earn revenue in small increments every month going forward. So if I just look the same graph on the left side, if I just convert it into a cumulative graph, you see that up till month 18, I don't make any money. And then only after month 18, I start making some money on the client. This is how bad the situation is for a SaaS company for a single customer. The problem that gets accentuated is that you don't want to do this for a single customer. You want to acquire many customers, and you want to keep growing as you acquire customers. You don't want to be acquiring at a standard rate of 2 customers per month. You want to be growing first month 2, then I will hire more sales guy. I would grow at 10 customers next month, 20 customers, 40 customers next month, and I will keep growing, right? So if you see on the left graph, your cost of acquisition will keep on increasing. But as the revenue of your initial clients keep coming up, your customer revenue will keep increasing exponentially on the upside. So if I plot this entire many customer profile on a cumulative cash flow basis, it would look something like the graph on the right side, right? So what happens is initially you start incurring losses. As you keep growing, there's a pretty big trough, but at some stage it turns around and then it starts coming out on the other side, right? So this is what a typical cash flow for any SaaS company looks like, right? The bad news is that you need to overcome such a big trough. But the good news is that a good SaaS company will come on the other side swinging like a serpent, right? So if you're an investor or if you're a founder of a SaaS company, it's a constant challenge for you to explain to your investors why these losses are good and why we will come out on the other side as a positive company. A very good example of a company that did this was AWS, that incurred such huge amounts of losses, but then when it came out on the other side, it had extremely good revenue run rates, etc. Another example is a company called Plaid, which recently was going to be acquired by Visa, but it did not. But so these are companies which have sort of understood that you need to incur such losses to come on the other side. Obviously, there will be challenges where on the other side, such profits may not come out. And that is what you as valuers today need to do to find out what good SaaS companies are and what are bad SaaS companies. Right? So let's look at what the SaaS company is essentially doing. Right? I've explained what the characteristics of a SaaS company looks like, but now I'm trying to understand what a SaaS company is trying to do. Right? It's like a machine that has got so many dials, levers that you can keep changing, etc. Right? But over time, a lot of VCs have sort of put this out, saying that technically you are only looking at 3 levers that you would want to alter in a SaaS company, which helps you achieve your primary objective of growth, profitability, and cash. Right? Because if you're not growing at least with the market rate, you're not a good SaaS company. If you're not profitable at the end of it, you're not a good SaaS company. If you don't make cash for your investors, you're not a good SaaS company, right? So to achieve those objectives, we look at the different levers that an entrepreneur would want to do. And as a valuer, it is your requirement to sort of challenge and find these information from your entrepreneur or your investee company to say whether are they doing this right or wrong. The first and the most powerful tool that we use is sort of a well-known concept now called unit economics. If I have to put it in very simple terms, in one simple equation, it is, can I acquire a customer for less than what I will make of that customer? Very simple. That what I make in the lifetime of that customer, can I acquire the customer for lesser than that? So on the left side, you have CAC, which is cost of acquisition. And on the right side, you have LTV, which is lifetime value of the customer. Now, this is where GAAP accounting fails, because GAAP accounting at best looks at a yearly picture. At its worst, it looks at a 3-month picture. But what we've seen that for most companies, for 18 months, you don't even know whether the company will turn a profit, or the first customer will turn a profit, or is that lifetime value correct or not. So in such a scenario, unit economics is something that really helps you understand whether the company will eventually come out the other side and really be the profitable unicorn that you expect it to be. A good thumb rule that a lot of VCs that now follow is that, is your LTV of a customer at least 3 times your CAC? So if your cost of acquisition is going to be $100, is your LTV at least 300? Only then will you really make money for an investor. Now the question is, should you increase LTV or should you reduce CAC? The answer is it depends. It really matters on what you are looking for in that company, what is possible. Each company is unique, and as valuers and as investors, I would say rather investors in the company, it's your obligation to find out what really helps. So let's go deeper into this and understand what the different components are. So first, let's look at the right-hand side, right, which is LTV. Now, LTV is a very simple formula. It's profit that you make per month from a customer into the lifetime of the customer. So if the customer is going to be there with you for, say, 5 months, and you make $100 per month, you're going to make $500 from that customer. The LTV of the customer is $500. So let's look at the second term, which is lifetime of the customer. Right? So lifetime of the customer is 1 divided by churn. It's a very simple formula. Say, imagine 5%. Now I'll explain what churn is. If 20% of my customers leave me every month, that means that 1 divided by 20%, that 1 is 1 month divided by 20%. That means that on an average, all my customers are going to stay with me for 5 months. That means every 5 months, I will need to get a completely new set of customers. So that is what the lifetime of the customer means. If I lose, say, 10% of my customers every year, if I'm a very good SaaS company, right? So companies, then I would have a lifetime value of 10 years of a company. Companies that have mastered SaaS sales, Microsoft that has time and again delivered value on SaaS sales has had not very high profit per month, but very high lifetime value. So that means a company which has very low churn has always delivered better. Now, there are two ways to look at churn. Most people would always track something which is called customer churn, which is saying that let's look at two case scenarios. I'll explain what is customer churn and what is dollar churn. But let's look at the first case scenario. I have two customers. Customer one gives me $1,000 of revenue, and customer two gives me $5,000 of revenue. In case one, I lose customer one. What happens is my customer churn is 50%, but my dollar churn is only 17% because I've lost 17% of my revenue, but I've lost 50% of my customer. Imagine the worst happens. The reverse has happened, where I lose my customer two. I have lost 83% of my dollar revenue in the time period, but my customer churn still remains at 50. To say one is better than the other is incorrect, because each one of them shows you a different nature of your business. The customer churn says that how good or how accepted your product is and how sustainable your growth is. But dollar churn says that what you can make of your customer, or how much more value can you extract out of the same customer. So let's look at case three. We have a customer churn of 15%. But what I do is that this customer two, of which I was making $5,000, I sell new products and I start making $7,000 of it. So I've grown the revenue of customer two by $2,000. Then my dollar churn becomes a negative 17%. And each one of these can be modeled in a DCF valuation to look at it. How? And these are questions that you need to ask your founder and see what answers that he comes up with. So let's look at a very simple example of Google, how Google or Gmail rather achieved case three scenario in this. So obviously the first axis is users. That is something which every founder is doing. That's the primary case. You can't keep suddenly increasing the number of users. Like if users are dropping at 5% per rate, suddenly they're not going to start dropping at 2%, or suddenly you can't start growing at 10% unless you have a marked improvement. So this axis has very little play other than your entire setup that you've done. But what you can do is that you can offer new features. So within Gmail, they started offering calendar that offers them reasons to start pricing more. Right? So one is a feature expansion in your product. Is the founder or is the company expanding into features? But most founders will come back and tell you that I have a single product. I barely make money on that. How can I invest in new features? Then you need to check, do you have the depth access? Can you charge users for using your product more? A very good example in Gmail is that they give you 30 GB of free storage. The moment you start using more storage, you have to pay them. And you start earning more out of it. You look at Apple. You buy an Apple iPhone. Once you fulfill your quota or your storage, you buy a cloud storage. They start charging you every month for that storage. This is how you increase the depth access or the feature access. So for any founder, you need to find answers whether there is growth in the depth access or there is growth in the feature access. Each one of this would lead to help you understand what your churn is, and then help you decide what your lifetime value of the customer is going to be. The other important factor in lifetime value is also to decide, or rather, how long does it take for you to recover CAC? So say in my first example, I said that we're going to spend $9,000 to acquire a customer, and we're going to earn $500 per customer per month per customer. That means it's going to take me 18 months to break even on a single customer. Imagine if I have the pricing power, or if my product improves and I'm able to reduce my break-even time to 12 months. Instead of 500, I start charging 750. You will see how big an impact that has on your profitability. So if you see those two graphs, right? So the first graph, the dark blue one, is of an 18-month break even. You see that you reach zero in month 18 for, say, around month 45 for the customer. And you at max would have, say, about $4 to $5 million of revenue of surplus cash by month 60. But by just changing the pricing a little bit, you are able to break even sooner. Now you can break even sooner by reducing your CACs or by increasing your pricing. You suddenly now have at least $55 million. And these are numbers that you can back calculate, and you will see how big an impact the break even time period has on this. So the second lever that you can, as investors, you need to look for is what is the break even period, or what is the month to recover CAC for a SaaS company. If, as a thumb rule, if it is 12, it is a very good SaaS company. If it's 18 to 24, it's an average SaaS company. Anything more than 24 is when you need to reconsider. So this is what the ground rule is. Also, another thing that you need to understand that has similarly profound impact on your cash flows is that if you collect money in advance, say, imagine tomorrow you have the pricing capability to start charging customers on an annual basis. You may say that instead of charging $500 per month, I'm going to charge you $6,000 once per year. Moment you do that, you would see it would have the same impact as months to recover CAC has. It would lead to a lot more acceleration of cash flows. That's why if you go to most SaaS companies, you would see that they offer as high as 25 to 30% discount if you pay annually. If you take a Zoom subscription today, if you take it monthly, they charge you at least $25, $22. But if you take an annual subscription, I think they charge you $15 to $16 on a comparable pack. That's the discount that they are willing to offer to accelerate your payments. And now you understand why it is so important, because that's a very strong lever that you as a founder or an investor would want to use. The next lever a lot of people talk about, or it is very counterintuitive, and I would like to highlight that here, is growth. What I mean by growth is that, say, if you're growing at 2%, at two additional customers per month versus 5 additional customers per month and 10 additional customers per month, right? You have different rates of growth on your customer. You will still see that your break-even period for any one of those 3 graphs don't change. If you do not alter your first 2 levers, this lever will not affect your ability to change your break-even period. What it does affect, it has 2 effects. It will come out as a sort of a spitting cobra on the other side with very high rates of MRR if you have a higher growth rate. But what you have to also realize that you will have a deeper trough. So if you look at the graph for 10, right, it has the steepest curve, but it also has the deepest trough. If you look at the graph for 2, it has the lowest slope, but it has again the lowest trough, right? So for any company, any SaaS company that you're trying to value, what you need to look at is what the growth rate is. But understand that this growth rate will not alter whether the company is capturing market share at the rate of 2, 5, or 10 additional customers per month. It will not change your break-even period. You will still need to have a horizon which is at least 50 to 60 months ahead to understand what will happen in that company. But the question that will come is that if a company can actually raise so much money, why wouldn't it always go for 10? Right? If it's only a function of raising money, present a story of 10. And this is where the next point comes in, that we don't live in an ideal world. We live in a fairly inelastic world where there is limitations, right? So this is what I call as sales modeling, right? Everything that we saw till now was customer revenue modeling or cost to acquisition to lifetime value. At the moment you start modeling it with sales, right, your cost of acquisition, you will realize that you need to hire salespeople, right? The salesperson takes time to reach up the curve, right? So right from month 1, say I start paying the salesperson $10,000 in salary But in month 1, he would only earn very little. It's only at say month 5 or 6 does the salesperson move up the curve, start making at least $10,000 of MRR for me. And then at one point, it will reach its capacity limit. It's not a purely inelastic. That same salesperson won't grow infinitely. I would need to hire the next salesperson, right? So it would always be a step function. So because it is a capacity limit, what is your hiring practice? How quickly can you hire the right sales guy? That's why I said the switch between the cash conservation stage and the cash burn stage is very stark and very sudden. You need to burn all that cash to ensure that you're capturing the right market share and you're operating at the right trajectory. Also, you need to understand how the product is. So in sales modeling, you would realize for a company, and that is something that will also help you drive your valuation. Hello. Okay, sorry. Yeah. So moving back, you would also realize that what is a high touch point.
నేను ఇందాక అంతా అబ్జర్వ్ చేశాను కదా, మీది 12 lakhs అబోవ్కి వెళ్ళిపోయింది.
Can you hear me?
Please mute yourself.
Okay, sorry. So just moving back. Just broke my train of thought. Sorry. So just moving back. So if you look at the sales modeling structure, what you're looking for is a product that sells with the lowest sales touch point. So say you have a product like Gmail, which is a freemium product that you start as a free, and without any salesperson ever contacting you, you will decide to convert it into a paid model. Some of it, not all of you, but some of you will do it. And that's the freemium model. Then you have something which is in between. It's a low touch sales point, right? The salesperson just contacts you, one helps you swipe the first credit card, and then you're on your way. Then you have a high touch point sales, and then you have something which is enterprise sales, where you need to sort of even offer post-sales services to your clients. I'm not trying to say that any of these methods is good or bad. What I'm trying to say is that each of this will decide what your rate of growth can be, and you need to accurately model it. So if you're in a freemium product and you're growing at 10% and the market is growing at 5%, it is still sustainable. It is possible that that will happen in the future. But if you're in enterprise sales, you will never beat the market in the long term. So in such a scenario, why you need to understand what's happening in the sales modeling, that will help you decide what growth trajectories that the company can take, right? Because if I move back one slide, you will see that this cash flow will decide what my valuation is going to be, right? This second part, the part at the end after the circle, is going to decide. Now, if somebody says that we're going to grow at 10 customer per month, right? Additional 10 customers per month, is that justifiable? That is what you need to answer. Does the sales model enable you to do that? That's what you need to find out, and you need to look. The question that may come is, for listed companies, how do you answer this? You need to either ask this question or look for answers from their past experience. So if I have to summarize investing in SaaS company at this stage into 3 key roles that we can do. Okay? One is, what is your month, or 3 key levers, right? This is all that you need to look for in a SaaS company. What is the month to recover CAC? A good estimate is 12 months, but even 18 is not bad. But just understand that if it's 18, the company will need to raise more cash, so that we should adequately discount for it. The second is LTV to CAC ratio. Some of the best companies like Microsoft have this ratio at around 7 to 8x. But even something as low as 3x is very good, and you should do it. And the last does not have a number, but does the company have the ability to collect payment in advance? So if you look at Zoom, which in its analyst call started declaring how much of its collections, like, so say if they had 100 million subscribers, how many of their 100 million subscribers paid annually? They wanted to signal to the street what their collection of advance payment was. Because they had a very good number, they were forthcoming with those numbers. Sometimes they may not be available and you will need to dig deeper, ask those questions. But if you're investing in a company at this stage, you should ask this question. So moving on, I will again look at this concept from the concept of value investing. We looked at the different levers that you can use or sort of play around with in a SaaS company or in any company, right? If it's Reliance Jio, the same nature has happened, right? Can they acquire new customers efficiently? Can they grow quickly? And can they collect payment upfront, right? If you look at Reliance Jio's plan, the amount of discount that they give for annual plans is insanely large compared to your monthly plans, right? They would charge you 149 for a monthly plan, but they would give you for 600 rupees, they would give you an annual plan. It's exactly this that they're trying to do. So now let's look at the concept of value investing. Now, value investing, as most of you know, will always say buy low. When your PE is low, you buy a stock. And when your PE is high, you sell a stock. Right? That's the notion that has become what value investing is. Right? But if you look at during this pandemic, what I've done is I have taken all the index stocks and I have listed them and sort of bucketed them into three categories: the high PE stocks, the median PE stocks, and the low PE stocks. And what you will see that during the pandemic, the high PE stocks dropped the least. And they also, from the bottom of the pandemic, grew the most. That means your high PE stocks were your buys and your low PE stocks were your sells. Does this mean that the concept of value investing is broken? Absolutely not. What it signifies is that you need to look deeper into what value investing is. It's just not numbers, it's also what narratives that are sold. Even in the first scenario, when you were trying to convince your board or your investor why on the other side you would come out profitable, and even though you're incurring so much of loss, which is increasing month on month, why it is beneficial, it is the narrative that you're able to sell to the person. Now the question is, what is more important, narrative or numbers? The answer is both. It's neither. But what you need to understand is that each one of them is closely interrelated to both. Now, there is a very good concept that Michael Mauboussin came out with in his book called Expectations Investing, which is a subset of value investing, which sort of covers this. What I will do is I will take that framework of expectations investing to explain how narratives and numbers are important for that same company. And I will look at under the purview of the lens of a company that has sort of played out in the last 7-8 years called Uber. And we've seen it right from its initial stage to a lot of challenges, to Uber would make losses, to its IPO, and it's doing fairly well now. So we would see through the different purviews and how that framework helps you decide what value investing is. Also, I would like to highlight one point here, that you should not get lost in the numbers, because numbers will only take you, because what happens today is when you look at most of the analyst reports or the equity research reports that come out on valuations, they're all numbers and they're very low on narratives. What I would want in the future is that both of them are given equal weightage. The numbers will change your valuation by only 10%, but your narratives can really be the differentiator in your valuation, and you will understand that why. But this is broadly the 6 steps in the expectations valuation framework. You start with the first step, which is called research. Then you build a narrative around the company. Then you challenge your narrative, whether you try to poke holes within that narrative. And I will show you how that is done, whether the narrative stands the ground. If it stands your challenges, then you convert your narrative into numbers. And these are very tangible numbers that can be converted into Uber. once you get numbers, DCF valuation is normal, what I touched upon briefly. But even after you do your DCF, that your sort of job is not done. You've not done with it. You put out your valuation and let people provide you constructive feedback on that. And basis that feedback, either you follow that same cycle again, or you stand by the valuation that you've come out. So I was looking at this company when I passed out of IIM. I was looking at this company Uber, and one of my friend joined this company Uber, and he was the second person to be hired by Uber India, and he couldn't stop talking about it every day. Like I was pretty pally with him, and he would every day talk about that Uber is going to be the next big disruptor, and it should be the one that you should join, etc., etc. I had not heard of Uber till the time, and honestly, my feeling that I put across to him was that I think he did not get placed anywhere. That's why he joined Uber. So what he did, like when I met him, he said that, do one thing, do your research. Here, download this Uber app, and on Monday when you go back to office, use Uber for the first time. So what I did, I generally drive to office. I used to drive back then, or I would take a public transportation. I used to never be a guy in India who would take cabs or taxis anywhere. Suresh Bhai came on Monday morning to pick me up in a car. I struck a conversation with him. I asked him, and mind you, before Uber, at this point in time in 2012, the only comparative that I had to a cab service was Meru Cabs. Before Uber, there was no other example like this, or Ola, there was no other example like this. So I thought maybe that Uber has bought a lot of cars and they've hired Suresh Bhai to drive me from point A to point B. I asked him, how much does Uber pay you? He said that no, Uber does not pay me anything because it is my own car and I'm driving you. And I said, great. Then I said, what happens? Like when we reach the destination, I said, okay, here, take the money. How much do you need? He said, you don't need to pay me anything right now. Uber has already deducted this money from you, and Uber will pay me 80% of what it has collected from you. Then it struck my mind that Uber is collecting 20% from me, or for whatever that I had to pay Suresh Bhai, only to be a matchmaker. It's a brilliant business model, I thought. I said that, you know what, why don't I become the next matchmaker and I start the next Uber in another city, right? Uber is already present in Bombay. So I thought that it's a company that had, that was doing matchmaking, did not need to really invest too much in technology. We could figure that out. And they were able to get anyone who had a car to pick up anyone who needed a ride and reach their destination. And what I quickly realized that I couldn't do this for 3 reasons. One, I did not have the money that Uber had, that it had raised a lot. And I quickly realized that at that point, Uber globally was valued, or rather priced at $17 billion. I've carefully used the word priced, not valued. So by VCs back then, so VCs are in the business of pricing assets, not valuing assets. So they had priced Uber that time at $17 billion. The second thing Uber had was network effect. The more drivers are there on Uber, the more riders would want to be. The more riders are there on Uber, the more drivers would want to be there. So me, out of my living room, could not run an Uber. And last, Uber was going to use data in ways that had never been used before. Meru never understood who wanted to go from where to where, or at what time should the driver be present in Bandra Kurla complex, and at what time the driver should be present at near my home. These were new things that Uber was trying to do. So I went back to my friend and I asked him, Uber does all this. Does this mean Uber is expensive? He said, no. Then I said, surely Uber would not be on time. And he said, no, Uber has so many drivers that it's always on time and it has the best cars. And that's when I realized that if you look at Uber's narrative, right, it's it was for me at that point, right? It was an urban car company that attracted new users like me, which could grow from city to city. Like today, it was present in Bombay and Delhi. It could grow tomorrow to a Bangalore, to another city. It gets to keep 20% of the revenue, and it has a very low capital model. By what I mean by a low capital model is that it's not investing in capex. What it is doing is that it's saying that it just needs to hire one sales guy in the new city, one hotel room, send the sales guy there and recruit as many drivers as it can. People will start coming, right? So it's important to build this narrative. Now, obviously, my experiment with Uber stopped there. But what happened further was a lot of stalwarts like Ashwath Damodaran, etc., started valuing Uber in real time back then in 2014, 2016, 2015, 2016. And I started tracking their blogs. So the next part will explain how this narrative fits into what they were valuing. I've tried to extract this narrative from their blogs of their valuation. Obviously, I've retrospectively tried to fit this in there, but you would see that it holds true, and this method holds true. Now, one thing before we go ahead with the Uber story, it is important to know in your narrative, right? So when you're building your narrative, you need to keep it as simple and as focused as possible. And you need to explain only one thing, or rather three, I would say two things in your narrative. What does the company do, and what is your pathway to make money? That's all that you need to build in your narrative. Everything else, we will do it in the next stage. But understand, right? So think about it this way, right? My co-founder really loves the Avengers movie. They made an 18-movie sort of sequels to tell me a 3-line story. That there is a shortage of resource, half the people need to die, we need to stop the villain. This was the 3-line story of the entire Marvel universe. So as founders, you wouldn't get an 18-movie canvas to tell your story. So you need to be simple, you need to be focused, you need to be precise. So the next step, so now once I've built the narrative, the idea is to challenge that narrative. Now, the framework that a lot of people have recommended is to do the 3 Ps to challenge your narrative, whether it is possible, whether it is plausible, and whether it is probable. Each one of those 3 is something that will explain, does your narrative have holes in them or not? Okay? I'll take a small digression here, and I will explain each of these 3, possibility, plausibility, and probability, with different examples. And then we will look at that in the context of the Uber narrative that we've built till now. If you look at possibility, right? So there was an analyst report that I was reading which said that Netflix in 2023 or 2024 is going to have a $600 billion revenue. For it to justify the valuation it had in 2015, right? So this was a 2015 analyst report. And I realized that for it to, like, if they're going to charge me $100 per user, they need to have 6 billion accounts, 6 billion users, unique users for Netflix to have $600 billion. Now, if the world's population is only 7 billion, there is no way Netflix is going to reach that valuation. So the point is, you need to figure out whether it is possible in realism. It's a binary answer, whether it's possible or not. If it's possible, then we will figure out whether it's plausible and probable. But the first answer that you need to ask yourself is, like in Netflix, it can never have $600 billion revenue. That means whatever valuation that we drive basis, those projections are incorrect. And there's been a study that basically they did this, that at least 1 in 3 or 1 in 4 analyst reports that most equity research houses throughout have an impossible valuation or have an impossible revenue target. And this is the holes that you need to break in. The next is plausible. Now, imagine it is possible, but is it plausible? What I mean by plausible is that Tesla will sell, there was an analyst report that said Tesla will sell 10 million cars at some point in the future. possible because the number of cars being sold is still far larger than the segment that Tesla wants to capture. It might be difficult, but it is possible. But that same report, to justify the high price, did not do any investment in factories to build Tesla cars. It just simply assumed that it will contract manufacture a lot of stuff, right? So these were things that you need to then understand, either if it's not investing enough in building factories in CapEx, then Tesla will never reach the 10 million car. That means it's an implausible story, right? So you need to break holes in that. The last is the weakest that you need to check, whether it's a probable, how probable it is, right? The answer is not anecdotal. Like, you should just not have a gut feel whether it's probable. You need to do your research based on it, etc. So let's look at the Uber narrative. If I look at 3 different ways to define Uber. Now understand, each of these words have been carefully chosen when I'm defining Uber. I'm saying Uber is a replacement for the taxi. Uber is a urban taxi service provider, or in the urban taxi market. It's probable. Uber is a car rental service company, right? I may say that, yes, something changes, it gets into a lot of different places, plausible. But what I put at that stage, or a lot of valuers at that stage who were very skeptical of Uber, said that Uber will never replace the car ownership market. People will still own cars. It's not going to go anywhere else. Uber will only be. So at that stage, this was in early 2014, Ashwath Damodaran came out, and this was the time when Uber was valued or priced at $17 billion. Ashwath Damodaran came out with his valuation of the company. And he said that, let me look at that same narrative that I had built. I've sort of extracted from his blog. And he said that Uber is an urban service, car service company that attracts new users that typically would not have used the taxi, are now going to start using Uber. They can expand city by city. That means they have strong local network effect. That means if Uber is dominant in Mumbai, Ola could be dominant in Delhi, somebody else could be dominant in Bangalore, etc., and so forth. It gets to keep 20% revenue, which is a strong indicator. And it also has a low capital model, which is also sort of verified by their discussions that we have in their business model that was publicly available at that point. So what he did was that he transported these narratives into numbers. He said it's the urban taxi market. In the US at that time, it was $100 billion market. He put that total market size as 100 billion. He said it attracts new users. That is why 6% is sustainable. On an average, a US company grows at 2.5%. He said 6% is sustainable because it is going to get new users. A latent demand will come up, and he tried to justify that. There wasn't a reason why you could poke holes on it. Right? He said that Uber conservatively would at least get 10% market share. Because it employs a low capital model, he said that they would have 40% gross margins and 5x return on capital. Again, typically a US company has 3x return on capital. So 5x was the upside that he gave in his valuation. Now, again, he could have chosen 6x, 7x. That's not the key point here. The point here is that how each of these points in the narrative translated to a single number that helps me do my DCF valuation. Now, basis this, you can start projecting revenues, like sort of cash flows for 10 years. And he came out with a $6 billion valuation for Uber. Obviously, at that point, Uber, and this happened in real time, I was tracking it. So obviously at that point, there was huge feedback and huge sort of blowback on Ashwath Damodaran's blog on saying that, how can you value a company at 6 billion, etc. And everyone had different takes on it. So obviously he, on his blog, he shared feedback blogs of a lot of different people. I've picked up 3 to highlight 3 points. The first blog that I pick up is the 538 blog. These are statisticians that sort of predict election results, etc. And they came back saying that, why it is 10%, why 6% is unsustainable, etc. It should be 5%, etc. And his response to that, like he's actually written this line, is that go ahead, change that number from 5% to 6% or 10% to 9.4%, etc., whatever that you want. And you will see that the DCF valuation does not change that much. That is why numbers can only take you to a certain extent in valuation. The next blog that he highlights is by a company called the Right Share Guy blog. At that point in the US, in Bay Area, Right Share was becoming quite popular, and there was a blog written about it. And he said that why your valuation is not correct, because even though Uber takes 20% of the revenue from me, it gives me back $1,500 incentive to continue riding with it. It has a lot of incentive programs, and I start getting it. Right? So that was something which he learned, and he said that's a very valuable point. But the most interesting reward that he got was from a guy called Bill Gurley. He's one of the founders of Benchmark Capital and early investors in Uber. And he replied in another blog. Obviously, he titled his blog to indicate, saying that Ashwath Damodaran misses by a mile, misses the Uber valuation by a mile, tried to play on the word mile. But he said that Uber is not just an urban taxi company, it's a logistics service provider. It will help you move from point A to point B. It will help you move your goods, food, etc. from point A to point B. It will have different points. The second thing that he said, that Uber is not just an urban company, because till that point in the US, taxis were only present in urban settings, in New York, Bay Area, Chicago. There weren't suburban taxis, there weren't cars in suburbs. You had to drive your own car. He said Uber will enter suburban market as well and provide you Uber services there. So it's not just an urban phenomenon. The next part, he said that Uber is also going to be a global networking benefit. And what he said that Uber would go and integrate in his, like if you read the blog, I think the blog is called abovethecrowd.com. And in the blog, he says that Uber would tie up with airline companies, would know where you're traveling. So your entire journey from, say, New York to Chicago would be seamless, where you would take an Uber to the airport, catch the flight, and take an Uber out of Chicago. And he said there will be global networking benefits. That is why local players will not exist. In 6 months, what Ashwath Damodaran did, post his original blog, he said, a lot of people gave me valuable feedback. Let me change that. So he first went with the Benchmark Capital blog, and he said that let me change it from a car services company to a logistics company. That target market is a $300 billion company. Since it has strong global network effects because of the reasons he's explained, let me change the market share to 40%. He changed the market share to 40%. And he again did his same valuation, and he came up with a valuation of 53 billion. He's put this up on his blog. But if you look at the Right Share Guy's blog, he said that he only said one thing. He did not challenge anything else. He just said that the 20% revenue share that you're talking about should be 10%, because Uber gives me back a lot, right? And that sort of explains why Uber at that point was losing 4 billion on a revenue of, I think, 3 billion. Why a company would lose so much with so little revenue? Because they give back in incentives, right? So he reduced the revenue share to 10%, and you see that the valuation that came out was 29 billion. So in a span of 6 months, the valuation by the same person of the same company without anything changing on ground changed from 6 billion to 29 billion. Okay? That's why I say narratives drive value. It is what you define your company decides what value you're going to get for the company. But there was an interesting study done around the same time where they took a class of valuation in one of the B schools here in the US, and they gave different narratives about Uber to different set of groups. and asked each one of them to come out with a valuation. And the students came out with valuations that were sort of debated in class between $800 million to $90 billion. That's the range of valuation that your narratives can drive. But does this mean that any number can go? If I can spin any story, anything will go? Absolutely not. As an entrepreneur, it is your duty to build narratives, but also to nurture those narratives and to execute on those narratives. You would only get so what narrative that you spin, right? So if I was the Uber founder, and if I would have only thought small and said that Uber would be a taxi company replacement, I would have only got a $6 to $8 billion valuation. But if I build the narrative and demonstrate execution towards it being a logistics company, I get the valuation of 30 billion or 17 billion or whatever that is. Right? So as an entrepreneur, it is our duty to build good narratives so that the narratives, and we have to nurture those narratives, we have to nurture those stories to build it into a bigger picture. And it's an iterative process. It's not something that you will be able to convince people in one go that you would create the complete end product, right? You have to keep nurturing, keep building those narratives. But as investors, what is our duty? Our duty is to push back and be skeptical. Our duty is to poke holes in those narratives, to challenge them, and to figure out whether those narratives hold water or not. If they hold water, you should invest in them because it makes sense. Now, in three ways, narratives can change. Narratives can break, narratives can shift, or narratives can alter. Now, let me explain all of them. What happens when narratives break? You look at crypto in India right now. Government comes with a regulation and says that from tomorrow, all private cryptos are going to be banned. You look at edtech in China, you cannot charge profit for providing online tutoring. Instantly, overnight, values of those companies have been destroyed because narratives don't exist anymore. Right? Narratives can break instantly. There could be changes due to macroeconomic scenarios. So understand that narratives can break. Narratives can shift. What happens is that you look at Maruti, it always has had one narrative. We build people's car. We build cars that India wants to drive in. We build cars as India's aspiration grows, slightly bigger cars, slightly smaller cars. That's the narrative Maruti always has. And if you see, Maruti always gives you a steady growth rate. Narratives can also be altered or changed. If you look at ITC, it was always a tobacco company when it had the first narrative. It became an FMCG company. It built on its narrative and delivered on execution. One of the best alterations of narratives that recently I have seen is Reliance. From an oil company to a telecom company, on how it built its narrative was really amazing to see. So as investors, we need to look at these narratives, look at these stories in motion, understand that stories will always change, understand that narratives can change because macro situation changes, like in China or like in India, government regulations come out. Narrative changes because the company decides to change that narrative, like in the case of ITC and Reliance. You should be vigilant to catch that trend and value the company constantly again and again. Or if execution is delivered, if a company executes well and delivers execution, you can be more aggressive in your challenges or your narrative and say that, yes, it should be done. So as you try to value, you should always try and understand that change is a constant. And finally, the last advice that I would want to give is to be humble when you're trying to value a company this way, is because most of your valuation, right? Like as I mentioned, valuations, narratives will change and break, but a lot of your valuation will also come is that you caught the right narrative at the right time, right place, and there is a place for serendipity in this. So always stay humble in this. And that is it. Thank you for your time. Any questions? Anything? I'm happy to take that.
Yes, anyone has any question can unmute and ask from Shivam ji.
I have a couple of questions.
Yeah.
You talked about the Uber valuation. Now, you also said that the explicit period growth rate was something around 10%. Is that what you said?
No, I said growth rate was 6%. I said 10%
6%,
market
okay.
share.
And what was the
10% market share.
what was the terminal growth rate?
So the terminal growth rate, I think, was 2%, which is the long-term US growth rate average.
2%.
Yeah.
Okay. All right. Okay. The other point which I want to make is, say, I would like to make a distinction between two different classes of SaaS companies, if you will.
Okay.
One class of SaaS companies is, as you talked about, let's say Uber or Geo, where people subscribe to the service. They subscribe to the service for a certain period, and if they don't like it, they can always make an exit. Uber is a one-time service. You get into the taxi, you get out of it. That's it. If you don't like it, you don't go back to them. Now, take for instance the other class of SaaS companies that I have in mind, which I'm talking about, and that is SaaS companies which provide data-based services. Take for instance our own in India, you have something called Apartment Adda, where your data is stored by them. Now, the cost of acquisition of a client in such companies could be relatively high, but once a customer is acquired, the exit by the client or the customer would probably happen most likely within the 1 year time span. If the customer stays with you beyond that, it is extremely difficult for the customer to move out because all your data is with them, with Apartment Adda, or take for instance QuickBooks.
So,
So it is extremely difficult for the person to get out. And therefore, the point I'm trying to make is, I don't know whether that would also play a role in determining valuations of such companies, especially where it is a database company.
So Srinivas ji, we don't need to complicate this so much. I'll tell you why. Because whatever that you have said gets reflected in churn. So if churn captures that accurately and adequately, you don't need to worry and distinguish between that. If a company, like you mentioned, right, bigadda.com or etc., that has high cost of exit, it will be reflected in its churn and the lifetime of the customer. So the formulas that I have explained put this out or capture adequate amount of variabilities and complexities. That is why I've tried to simplify it as much as possible without going overboard on simplifying it. I've done it to the extent possible, but not more than what was needed. So that is where I would try to answer your question. But however, case by case, definitely you should look at it. You should look at the narratives that people are trying to say and why it is. So if somebody like the Big Adda comes and says that my churn is very low, and you have justifiable grounds in the challenge phase to answer it, then you should definitely stick by its churn values. But if you don't, then lower your churn or sort of increase your churn and lower your lifetime of the customer.
Okay.
Yeah. Yeah. Next question.
No, those are the 2 points I mentioned. One is about
Sure.
Uber, then the other is about the 2 different classes of SaaS companies that I had in mind.
Because my only sense is that it becomes difficult to classify because each business is unique, and the more you try to classify, the more nuances you need to build. But from a finance perspective, you're doing something very simple. You're acquiring a customer, you're seeing its lifetime and seeing whether you're making value. You're not doing a penny less or a penny more. So that is what you
So for
should
instance,
capture.
in the case of an Uber, client, the lifetime of the customer could be just about 20 minutes, 25 minutes, the journey that he makes.
No, but
So
how, the lifetime of
based
the
on
customer.
based on market information that there's been a misbehavior by an Uber driver,
Mm-hmm.
I may not go back to Uber.
Yeah, that is possible. But so in Uber, the way you check lifetime value is not the actual duration of the ride. You check is how often that the customer keeps repeat booking. If you have a very bad experience, that's a dropped customer in 1 month. So each month that you keep booking adds to your lifetime of the customer.
True.
So so those are different concepts to explain. Like I can take another 3-hour session on how to calculate lifetime value of a customer and etc.
That would really be great if you could do that.
So that's
If you could do that,
I can
would
keep
be
going deeper into one topic as well. Like, and there is no end at sight. So I have tried to be slightly topical on this session, but definitely in the future I can organize.
Sure, if you could go into more detail, drill down a little more, that would really help.
Yeah, yes, with time, definitely I can do that in a separate session.
Sure.
I think we can go to Deepak ji.
Yes.
Sandeep
You had
ji,
a
Deepak ji,
I
unmute
have
yourself.
a couple of questions.
Yeah.
Yeah, sure.
So one is, what kind of share of wallet do we factor in case of a slightly competitive marketplace where we do not have a monopoly kind of advantage. Second is there will be certain kind of retention cost, CRCs, as we move beyond a certain life, beyond a certain month. What kind of factoring do we do for SaaS companies?
Okay, so for your second question on CRC, it does not matter what your CRC is, what's your technically, if it's if you have to retain a customer and you need to pay him 10% of your acquisition cost, you add that into your CAC itself, because that's what a new customer, to get a new customer would. So either you look at it 2 new customers with smaller lifetime values, or you look at 1 big customer with a larger CAC. That is one way to do it. The second question that you asked, right? What was the first question that you had asked? Could you just repeat that?
So it's about the share of wallet.
Share of wallet. Yeah. So in share of wallet, a good estimate, there are 2 ways to estimate this. One is, what do you foresee the end scenario to be? Now, what I mean by end scenario is the end game in that industry to be is that there are 10 players right now, and they're going to consolidate to maybe 4 or 5. It happened in telecom, right? Then you can effectively say that at least 25% or 20% will hold ground in water. Right? So you need to look at in scenario and see this is where the company needs to go. Obviously, company needs to get its execution right. But in a very highly commoditized market where you're seeing that there are players that come in, look at what is the entry barrier for a new customer or a new person to come in, and build your narratives around that. So a good way to look at it is, what is the current share? What is it growing? Extrapolate that for 5 years and stick to that for at least some time period. That is one of the ways to do it grounds up. Or if you're doing tops down approach, you should look at what the end scenario should be. So effectively, you need to decide whether this company is going to be the one that exists in the end. And when it exists, will it be 1 in 4 or 1 in 3?
Thanks.
Yeah. Okay.
Shivji, one other question which I have in mind is the churn ratio that you mentioned, or the churn rate. Now, that is something that is not necessarily applicable just to SaaS companies. It can probably apply to quite a few other industries, right? For instance, take the professional services firms. The Big Four want themselves to be valued. Now, valuation of Big Four, they will also have a churn rate, won't they?
Yes. So in fact, the Big Four audit services, technically a SaaS product, right? In the characteristics that I've defined, a high cost of acquisition and annual revenue year on year that you get, right? So anything that behaves that characteristics, you could use these models and tools that I shared today. You don't have to stick with SaaS. The reason the topic mentioned SaaS was to build an anchor, but in the concept that I built, I did not explain only SaaS. I said any company that exhibits this characteristics, which is very pronounced in SaaS companies, but does not mean it's only restricted to SaaS companies.
Is there any reading material on churn ratio?
So at the end of my slide, I put up two references. One is something which is called forentrepreneurs.com. It's run by David Skock. He's one of the most respected VCs here in the US. Then there is, you can also look at these exact Uber valuations that I picked on Ashwath Damodaran's blog. You can also look at Michael, if you're interested in reading, there is this book called Expectations Valuation by Michael Mobosin.
Can you just repeat that? Expectations
Valuation by Michael Mobosin.
By Michael?
Mobosin. M-O-U.
How do you spell that? Is it possible for you to put that in the
chat?
I'll
just type that in on the chat.
Sure.
Till then, I can take the next question.
I have a good question. So
yes,
we have gone through your presentation, and it's quite clarifying and more giving thoughts as to how the valuations are crystallizing. Now, while the numbers with respect to SaaS models are okay, can I apply a similar or a variant of this to somewhat disruptive startup? Because I anticipate that there are likely to be very heavy level of disruptive startups coming up, like in drone technology space as and when we go by. So with cusp of technologies emerging into, say, electrical engineering and AI, or AI and data science, electrical engineering, data sciences, and some sort of molecular biology being thrown in for a some sort of a solution for enzymes too. So these things may create more complexities. And how do we value those type of entities, sir? Where the product is not proven, but there's a good challenge is coming up.
So that both of those, like AI, unless it reaches a stage where you're in growth stage. So the model that I've discussed today is specifically for the growth stage, where the product market fit has been established. That is the critical junction. Everything before that gets into the purview of a different format of valuation, be it angel investing, be it Series A, B, C investing. And there are different ways to do it. And obviously you can think about it and figure out how to value. You could do something which is called a split option DCF, which is basically saying that if something happens, the valuation will jump up. If something does not happen, valuation is, so you basically build a base case valuation and then you build an option valuation on top of it. And you can start doing modeling on that as well. But those do not fit in the model that I've discussed right now. So I would just like to clarify, a product market fit is the critical junction beyond which such valuation models will work, provided they exhibit characteristics of what a SaaS company does, which is high initial cost of development and high initial cost of acquisition.
Hi, this is Rajiv here.
Hi.
So I have one question. First of all, thank you very much for a nice session.
Thank you.
I just wanted to ask one basic question. And in the Uber valuation, with the narrative change happened, there is a drastic change in the valuation. So I was just checking. When Ashwath Damodaran had done the first valuation, of course, he has taken the criteria of the projected free cash flows for the valuation. And when he did the second time, this is something that they have done with a different projections at the same time, along with the different perspective.
Yes, they've done it with two different perspectives. So basically, if you see my table when I had highlighted, they've changed the size of total market. They've also changed the market share. Those were the two key drivers that changed the valuation from 6 to 50.
So the market share change is something based on the projections done by the company with the increased market perspective.
Not in this case. So the increased market perspective gave them a $300 billion target market. the increased market share came because they said that Uber was one of the leaders and there is going to be global synergies. By what I mean by global synergies, saying that people would want to ride Uber in New York and Chicago. They wouldn't want to differentiate between the two. There would be fewer players that would exist. Like if you look at India's market itself, right? You had so many players that had started out, Taxi for Sure, etc. All of them eventually amalgamated into two players, Ola and Uber. So his point was that he took a conservative 40% market share because he said that only 2 or 3 players will exist and Uber is going to be the market leader. That was what his end scenario was.
Okay, thank you very much. And one more question is that there are a lot of deals happening in the market with various types of companies, various stages. So can you suggest reading reference or a source where we can actually go and understand the valuations happened in
So
the market?
the best source is to read the red herring perspective, and then to do this valuation, this narrative building and valuation yourself. And if you are convinced it makes sense, it should be done. Otherwise, the other ways to get information is typically blogs, or a lot of VCs like to talk about their investee companies. That's how, so typically for private companies, that's a good source of information. And the last source for information is actual users. You should also always do your research with actual users of that product or that company.
Okay, thank you very much.
Just one point for everyone in the session, that Sandeep ji has shared a Google form link for feedback. Please do fill that. It's a 2-minute 4-question form. That would be really helpful for me. Any other question?
No, there is no such form that has come. Oh yeah, it has just come. It's just
one more person, Sugna ji, asking, what is your take on Zomato valuation?
So that is something which I don't know, and I've specifically tried to refrain from cases that have currently not been played out, etc., for obvious reasons. So you should but definitely, if you are happy to build that valuation and you want me to outside this call look at it, I would be happy to look at it individually for you.
That will really help. And hope you will be sharing the presentation with me so that I can share with the...
Yes. I will separately share that with you.
Because your one session is not enough. We will have on more topic, more presentations also.
Okay. Hi. One more is not enough. I think we'll need 2, 3 more.
So in different intervals, we will have seasonal.
Absolutely.
Yes.
Hi, hi. This is Aksham Gupta. Am I audible?
Yes. Please.
Yes. So I want to ask one question about what is the IPO result that is came of Paytm and Latent and Nykaa and all. So the Paytm is having already a very good brand value, and the hype of the IPO is very well. But when it comes to a Latent, so it was not that much. So Latent does not have that brand value. So what's your take on that? Why the Paytm listing price is so low and all, and Latent is so high comparison to the percentage of its the expected price and all. So what's your take on that?
So again, I have not followed both those companies closely currently, but my novice take on that is how you convince people on your narrative. Are enough people convinced whether your narrative holds water or not? And you should take some time to do that for Paytm and Latent, share that across with us, and as a group we can sort of work on that offline and see if those narratives hold water or not.
Okay, thank you. And actually, I'm not in the group.
One of the questions, Shivanji, you right at the beginning you mentioned that you're only looking at the income approach to valuation and not the asset approach or the market approach. Is there a reason why you said that? Because asset approach, most of these companies would be pretty heavy on the investment in their softwares. So, is there a reason
Okay.
why you
So-
not look at the asset approach?
So most of these companies are actually asset light. That's the reason why VCs are very interested, because they are cash churning machines. Like the best cash churning machine that's ever been generated is Apple. But if you look at its balance sheet in terms of actual assets that it owns, is quite limited. Even it has lesser than General Motors and Ford. So these companies are not valued very highly on their assets. They're valued for their cash flows. That was one. The second point that you asked was on multiples. Now, for companies which are so early in their game, multiples do not give you an intrinsic value. It also has an element of market expectation. So that is why I try to refrain from that. And I try to use more intrinsic values to see, because see, my point is, if I get an valuation wrong and I don't act on it, or I'm underestimating that value basis intrinsic, I don't act on it, I don't lose anything. I just miss out an opportunity, which is okay, which is at some point you need to catch the right narrative and the right story. But if you start factoring in market expectations in your valuation, you are not being true to your value investing roots. Like I know one of my very close friend who runs his own investment company, and he does not even look at markets. Like every quarter, he just gets a tracker saying that this is how the investment is doing, but he does not even look at market, what's happening in the market. He is so sure on his intrinsic value investing that if he's taken that decision basis value investing, within a year, it will show value, it will show results. So it depends on your approach. Like how are you looking for value investing in the truest form, or are you really looking for the marketized version of value investing, saying that you buy low, sell high, which is the P method, which is sort of a shortcut. That's why I highlighted why that method is broken. And
Okay, no, I was not actually suggesting go for PE approach completely,
Sure.
but use that as the basis to compare your valuation with the other approaches and to see where exactly you stand. For instance, the company may give you fantastic projections, which as an outsider, a person doing the valuation, you may not really be aware as to whether it is doable, not doable, and what kind of risk weightage you need to give it. So a valuation done on the other two approaches will give you a certain kind of a benchmark for comparison. I'm not saying that you should take only one of these three, but then probably make use of the other two just to benchmark and compare, and maybe take a weighted average.
I would differ there. The reason I would differ there is because in such companies, when revenues have not seen its fruition, right? You're still in that trough phase, right? Most companies are now going into IPO still in its trough phase, right? But they're expecting that the upswing is going to come out. At that stage, when things are so dynamic and changing, market expectation is very volatile. The second thing that also, if you average everything, you've just sort of not trusted your intrinsic valuation, because the company may give you projections, right? If you look at Ashwath Damodaran's valuation of 6 billion, he does not use any projections from what the company has done. He just simply said that the company in 10 years is going to get 10% market share. Let me grow that linearly and project revenues what it would have been. The company may or may not hit that. It has nothing to do with it. Eventually, the two will converge somewhere, right? So trust, I would say, trust a single method and poke holes into it, build confidence into those methods, rather than to sort of look at something here, something there, because your idea is not to be, if you're a value investor, your idea is not to go with the market. Your idea is to be contrarian. You will make a lot more money if you're contrarian and if you find the right bets. I think you are.
Thanks a lot. Thank you so much. Very interactive session.
Yes, I think we are almost done with time as well.
Now I
leave
think Sangeeta Parmarji will do formal vote of thanks for the session today. Yes, Sangeeta.
Thank you, sir. Good evening, everyone. I now propose formal vote of thanks on behalf of Association of Professional Valuers. First of all, I would like to thank Speaker Shivam Nayak. Sir, you have given a different way of seeing a loss-making company. Earlier, when we do any company which is making continuously loss, then we thought, how can we give value to that? You have given other way to look at that company by way of investor and by way of founder. So in that way, you can find some value and then you can build up, yes, we can calculate some value for that. That's really like finding diamond under the pile of mounting losses. That really worth that. And second thing, what is narrative derives valuation? That is very true, but to me it's like a time bomb. You say anything and valuation goes down from 6 million to 53 million as we see just Aswat Damodaran sir has been calculated. But being a valuer, we are in between. We are not founder and we are not the market, which is, we have to give us something which is going to be real, which is going to be like, we have to trust the founder and we have to calculate some value on to present. So that will all, as a valuer, we are going to face in lifelong. That was truly like you are giving a such an insightful and you're open certain different area of thinking about the loss making company and how to value and how to value that company and what else we can put in that. Thank you for that. Now I would like to thank you, our audience, who have been so attending the seminar and being so patiently listening. And furthermore, I would like to congratulate our audience because they are all are open-minded person and taking time for their growth. So now I would like to thank you, CA Kripesh Bhansali, for giving a brief introduction of Association of Valuation, brief introduction of APV and introduction of our speaker, Mayank Nayak ji. At the end, I would like to thank you, our organizing team of APV, under the able guidance of CA Sandeep Kumar Agrawal, Chairman, Head of Professional Development Committee, Chairman CA Ram Mohan Bhave sir, and President CA Ram Mohan Bhave sir, and Vice President Shudha Bhushan ma'am. At the end, on this note, I Sangeeta Parmar, take your leave and hand over the stage to CA Sandeep Agrawal sir. Over to you, sir.
Thank you, Shivam, for wonderful deliberation. It was really a nice and knowledgeable session, and we all were very much enlightened by your insight and deep knowledge. Hope you will continue to be with us and share more insight in the future. Thank you very much for the day. Thank you.
Thank you. All right.
One more thing, sir. Shivam sir, if you can a little bit give a brief intro of your startup Resofin, that will be, I'm curious to know about that.
Okay, so basically at Resofin, we run an invoice discounting platform for banks, and we work with banking partners to sort of discount invoices for logistics companies and separate different unique cases. So this is what we do at Resofin.
Thank you, sir.
Okay, thank you very much. Good night.
Good night, sir.
It's good morning for you, but good night for us.
All right.
Good morning to you.
Very
Have a
informative.
great day. Have a great day.
Have a
Okay.
great
Have a great day.
Thank you all. Please fill the feedback form before leaving the group, and that will really help. Okay.